Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 338 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the most recent jobs report, crypto weakness, the U.S. dollar's pattern during the Trump administration, trucking volumes, inflation, and capital expenditure budgets for mega cap tech companies. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So good morning, Matt.
Good morning, Mark.
Not a whole lot in terms of like major news headlines, I would say, over the past couple of weeks here, but there has been a little bit of volatility return to the market, especially getting through, the major 2 weeks, I would call it, of earnings season. Some of the software names getting crushed because of, concerns AI is going to make their businesses obsolete. Weaker than expected earnings reports and future guidance. So there has been a little bit of volatility that has come back to the market, at least for right now. It seems like it was relatively short-lived. But nonetheless, saw that VIX climb up above that 20 number, which kind of makes our ears perk up.
It's going to be interesting.
Moving on to returns for the month and for the year. As always, this data is from YCharts, and as of the market close on February 11th, S&P 500 index is flat for the month of February, but up 1.4% for the year. The Dow Jones Industrial Average up 2.5% for the month and up 4.3% for the year. The NASDAQ Composite Index down 1.7% for the month and down 0.8% for the year. The Russell 2000 Small Cap Index up 2% for the month and up 7.6% for the year. And then the Vanguard All World X United States Fund is up 4.2% already in February and up a whopping 10.2% for the year. 3-month Treasury rate at 3.7%, the 2-year rate at 3.52%, and the 10-year at 4.18%. Moving on to big headlines, current events from this week. Only thing I want to talk about here, Matt, is the jobs report for January released by the Bureau of Labor Statistics. I believe it was yesterday. Non-farm payrolls increased by 130,000, beating the expected consensus of 55,000.
That's a big beat.
Yeah, it's a huge beat. Yeah. Unemployment rate edged down to 4.3% in January, following a 4.4% rate in December. And then I think the biggest news here was that the 2025 annual revisions showed only 181,000 jobs added, indicating 2025 had the slowest job creation in 2 decades, excluding recessions. So that's what we got to remember about all of this, especially government data, is it's subject to get revised, right? We see the same thing with GDP. So whenever a number comes out, that is not hard and fast that is going to be, set in stone, so to speak.
Yeah, and I think when you have a change in leadership, and for better or for worse, incoming administration drastically shakes things up from the previous status quo, it could rock initially, say, business leaders' confidence in growing the headcount, right? And, the latest data is obviously showing some economic pickup, which I'll be discussing in here regarding trucking. But the employment data for last year, that doesn't surprise me, given especially how the year started with all that tariff uncertainty in February through April, right?
Right. Yeah, for sure.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to tweets, articles, research from this week. First thing I had was a post on X from Wall Street Wingman on February 9th.
Okay.
And it was a chart of Bitcoin all the way back to when Trump got elected, right?
All right.
So this is going to be the fall of 2024. He says Bitcoin is trying to hold the Trump pre-election day level. Pretty wild given the most pro-crypto backdrop it's ever had. So Bitcoin on February 9th got to a point that was lower than the day that Trump got elected, right? And it's no secret that this administration has been very pro-crypto. And I think it just, again, it's one of those good examples, in my opinion, of, when you make a investment decision based on who is going to be in office or some certain regulation that gets passed that you theoretically in your mind think, oh, this investment's going to be great because the administration embraces it, or this new regulation makes it easier to do business. And the exact opposite happens. Now, I'm saying that, from this point in time, because crypto from Trump's election did skyrocket to 130 or 140,000 at one point in time. But if you had held it since election day, you would be underwater or just roughly flat, right?
Yep.
And the best example I have from the previous administration is the Biden administration was clean energy stocks, right? So once he got elected, everyone was like, oh, green energy is going to outperform traditional oil and gas and coal. That didn't happen. Traditional oil and gas outperformed green energy by a substantial margin, right? So it's not always the case that if something makes sense in your head from an investment thesis that it's going to play out.
That was the example I was going to give, Mark, and I think it's a good analogy. And I think it's just kind of a cautionary tale. Also, you don't want to be putting all your eggs in one basket, right? Even some of the most slam dunk oriented investment theses can fall apart at some point.
Right. Exactly. And that's not a recommendation for or against Bitcoin. Just pointing that out.
I got a sidebar on the Bitcoin topic. I saw someone overlay a chart of a subsector of the subsector of software, and they overlaid the chart of the Bitcoin price to this sub-software sector, and it has like high correlation.
Yeah.
And so someone was attempting to extrapolate watching the software stocks as a leading indicator. I'm not saying there's any credence with it.
Right.
I found it interesting.
Right. Next thing I had was a post on X from Mike Silva, also on February 9th. So it is a chart of the U.S. dollar during Trump's first administration
here we
and
go.
so far to date in his second administration to see if there's some sort of correlation or pattern. So Mike says, this is getting stupid. The blue line is the Trump dollar from 2017 to 2018. The orange line is the Trump dollar from 2025 to current. And what do you see here, Matt? The performance of the U.S. dollar is pretty dang
Correlated to his first administration.
And the dollar has been weak since Trump took office. And what have we seen? We've seen international stock outperformance. Typically when the U.S. dollar falls, multinational companies that have earnings and revenue overseas, that's worth more. Hence, their stocks tend to do better. And that's why we're seeing, I think, a lot of this international outperformance over the past year and a half. But the interesting thing is, which we talked about, I think, a couple of weeks ago, is that we're kind of at the point in the calendar where, at least during the first Trump administration, the dollar started to strengthen. So it's going to be interesting to see if that follows suit in this second term. And if that, again, would translate to maybe the U.S. outperforming, even if it's just for a couple of months, because it's been a pretty stark outperformance from international recently.
I think that's well said. I think that this needs to be a major point, that if you are an investor who's overweight international, you need to be aware of this. And you got to look at the seasonality. And if the dollar does start to strengthen, does it immediate spell trouble for international stocks? No. but what's a tailwind today becomes a headwind. And you just got to be aware of that fact. And it needs to be pretty high on the list, in my opinion.
Yeah, agreed. Last thing I had was kind of just a fun one regarding the Super Bowl. So
we're not going to talk about the halftime show?
We can talk about the halftime show if you want. We were actually talking about this, and again, this is like, it's such like you're on one side or the other.
Yeah.
And it's just more heightened this year because, the administration's gotten involved in stuff. But I think the last halftime performance that I guess the two that I can just think of off the top of my head were Dr. Dre when he had
Eminem and Snoop Dogg,
50 Cent, and then Bruno Mars.
Yes.
Bruno Mars was a great one. But other than that, I can't really think of like anything that stood out in my opinion. I guess I just don't understand why it was so polarizing in the first place. I was traveling with my kids, visiting my parents, and I was exhausted from that day. So I actually was asleep during most of it. So I can't tell you a lot of what happened. But yeah.
When it comes to this topic, I think people are bored and they need to move on from it.
Yeah,
it's really not a big deal. One of my favorite memes I've seen this past week, for those that know me well, they know I'm a big Dave Matthews fan. So there's this meme that's going around right now along the lines of, don't even come at me and say that you're not happy that you don't understand the lyrics. And it shows a couple of lyrics where Dave is singing very quickly.
Yeah.
And some of his lyrics, when he says it, you're like, what the heck did he say?
Right.
So that's like rotating right now. And I think it is so funny.
Yeah, that's great. That's great. But this, I think,
I made you digress. Sorry,
yeah,
Mark.
that's okay. That's okay. This was a thing that should be welcomed by investors. So historically, a win by the NFC team has foretold a bull market, whereas an AFC team win predicts a bear market. So the NFC, the AFC, the two conferences in the National Football League. And good news for investors, the Seahawks won the Super Bowl and they are in the NFC. Obviously, the only bad news was that the game was a snooze fest.
It was a snooze fest, yeah.
Literally and figuratively for me, it put me to sleep. But I will take
great dad joke right there.
I'm getting better at those. I will take a bull market or the hopes or the probabilities of a bull market over an exciting Super Bowl any day of the week. And I think for what we do, that makes sense. So, yeah, quite a boring game though, huh?
Yeah. I mean, everyone was way too conservative.
Yeah.
Especially the Patriots. The underdogs were way too conservative.
Yeah, they're both, I would say, their defenses kind of outshine the offenses. I personally think it might have been a better game if the Broncos were in there and Bo Nix was healthy. But what are you going to do?
This is why I would prefer just two really strong offenses and two horrible defenses and just see them run up the score on each side.
Right?
Yeah, let's see it.
Yeah. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Okay, so my first piece, Mark, is about trucking volumes being high right now. Now, this has evolved for me over the past week and a half, as I started to see some data about this, and it started to gain a little bit more steam as time has gone on up until yesterday when I did my podcast notes. So I'm going to try to break this out in chronological order as I was seeing the data, okay? So the real-time data is showing a dramatic tightening in the U.S. trucking market. with rising rates, volumes, and rejection indices could be signaling positive economic data in the near future. I'll break this down for listeners and viewers here in a second. The data I'm about to discuss indicates to me a bit of a structural economic shift, not just seasonal or weather-related noise. Speculation has tied this to a manufacturing resurgence and policy changes from the administration. I'm going to be referencing several posts by Craig Fuller. Craig Fuller is the founder of FreightWaves, and it is a very popular blog and site that provides raw data on the logistics and trucking industry. In addition, they've developed some proprietary data called Sonar, and it provides like rejection rates, volume, the average mile that people are paying for trucks, a lot of like raw data in the logistics area, okay? My editorial side of this is this tends to be very sensitive. You can tend to see, large movements very quickly in the economy, okay? So let me continue. On February 5th, Mark, we were starting to see rising spot rates signaling early strength. Spot rates is, I need the truck today, and what is the cost per mile, okay? So trucking spot rates have climbed 61 cents per mile since May of 2025. It's reaching levels that are unusual for this time of the year in early February. This is typically a slow period of the year.
After the holiday season.
After the holiday season, right? Makes sense, right? So this defies seasonal norms. Volumes tend to start picking up in March with this strong happening earlier than expected. Some are speculating that the typical spring strength could be a very profitable environment for truckers. So reduced capacity. One thing I want to note, there is reduced capacity from what we would call a compliance crackdown. You are having underqualified drivers. I just want to say it directly. You have illegal immigrants who maybe are taken off the road. So now you have less truckers on the road in addition. And then you have, and I'm quoting Craig here because I want to be careful using this word, surging demand from retail, manufacturing, recovery, housing, and autos. There have been replies to Craig's post saying that brokers are paying $4 to $4.50 per mile for a spot on the kind of the rate that day for loads out of Chicago, showing real world tightness. So the first thing I want to reference, Mark, is this chart that shows the current mileage rate. And right now, Jenna will put up this chart for our YouTube viewers. We'll put this in our show notes for our traditional podcast listeners. What you're looking at here is his proprietary Sonar National Truckload Index. It's showing a 7-day average of what individuals and companies are paying by the mile to hire a trucker. Obviously, let's look at this through the lens of supply and demand. If there's more demand for a good or service, what happens to the price, Mark?
Goes up.
It goes up. So what you're illustrating here is individuals are paying the highest rate per mile in a year, and the trend, it's going up very quickly right now. So let me continue. I saw that piece on February 5th. I'm going to build a picture. Then on February 7th, I saw this. Volumes, remember, we were talking about cost per mile, okay, on the spot rate. This is about volumes. Surging volumes at multi-year highs. Trucking volumes hit their highest point since October of 2022, with no slowdown in sight as the week closed. Craig has reinforced this isn't just weather-driven. It's a structural change in the goods economy, with manufacturing coming back. And when you look at some of the economic data, freight data tends to lead official stats, and it aligns with the ISM, PMI being over 50, and rail carloads being up 4.2% year over year. So next, Jenna will put up this chart of truckload volume index. This will be in our show notes. This chart, Mark, goes back several years, about 3 years, and you can very quickly see the pickup in total volumes being the highest since 2022. So I saw that. That was kind of data point number 2, okay? And then I'm starting to get a little sensitive to this, okay? So the next thing I saw to take this home was on February 11th. He showed something called the Chicago Rejection Index as a leading indicator. as I've been in my career, one thing I realized very quickly is that Chicago is definitely a central distribution point for the Midwest for the movement of goods and services. It's a huge rail hub, and everything kind of spokes out from there, okay? So truckload rejections out of Chicago spiked to 13.3%. This surpassed December's 2025 holiday peaks, and it's hitting March 2022 high levels. Again, that's the highest in nearly 4 years. Chicago's central role makes it a bellwether for national capacity. So I want to throw this out there. When I sit there and say the rejection rate is 13.3%, I'm going to put this into context, okay? A rejection is the percentage of truckloads that shippers offer that are then said no to. They could be say no to because they don't have the capacity, they think the rate's too low. And so how Craig defines this is if the rejection rate is under 5%, he says there's plenty of trucking capacity available. Carriers are eager to accept almost any load. Moderate rejection rates of 5 to 8% indicates the market's starting to tighten. Anything over 10%, that what he defines as a serious capacity shortage and contract rates are too low. Carriers will reject contract loads to chase higher paying spot market opportunities. And we're at 13.3%. Let me continue. So the rejection rate over the last 3 months is up over 7 points. And so Jenna will put up this chart for our YouTube viewers, and you can kind of see that rejection rate. So why am I bringing this up? You've had an administration, Mark, that has been pushing onshoring and nearshoring for economic activity. You've seen the utilization of tariffs, which is incentivizing companies to do domestic production, right? So you are actually, in my opinion, starting to see companies make decisions, and I feel my speculation is a lot of this has to do with a lot of these factories and manufacturing are going to happen in the Midwest. The other stat that I saw that was crazy is of these regional metropolitan areas, the one that stood out at me for trucking volumes year over year was Columbus was up 32% year over year. And you're seeing it huge in what you would call the Midwest or the Rust Belt. Another thought, California, a lot of imports from East Asia go through the West Coast. Trucking volumes in California year over year down 17%. So I just find it really interesting to see the administration, again, for better or for worse, their policy actually happening in real time that I'm seeing with the trucking data. Overall, I don't think it's a bearish thing for the American economy. However, we got to keep an eye on the inflation front, which is my next thing. Any comments before I continue?
Yeah, the only thing I'll say is that I mentioned earlier in the show that over the past week or two, we've had some increased volatility, some selling in some of the more risk-on sectors. Mm-hmm. But the interesting thing is one industry in particular was showing amazing relative strength. And what was that? It was transportation. Mm-hmm. So if you take a look at the transportation popularly traded ETF, IYT, I believe it is the ticker symbol. When the market was down and volatility was increasing over the last couple of weeks, transportation companies did relatively well.
Yep.
So it's interesting to pair, stock performance with the data that you shared regarding trucking in the economy.
Well said. Good point. As you were saying that, Mark, it makes me think of some old Wall Street adages. And I probably know where I'm going with this. The old Wall Street adage is when you have the transportation sector moving higher and even bucking the trend in the market, that's a very bullish thing. Not just bullish. Historically, it tends to be very bullish. Your thoughts on that?
Yeah, you just don't see bull markets ending when transportation stocks are outperforming.
Boom.
Yep.
Okay, let's talk about inflation. This is a banger podcast. Okay, Mark, I'm going to sound like a broken record here. Let's have a discussion on alternative inflation metrics, because right now, the real-time data I'm seeing in inflation is quite interesting. Okay, so Anything you want to say before I begin?
No.
I apologize.
Nope.
So Trueflation, I mentioned them on the podcast from time to time. They are a real-time data aggregation research firm. What they attempt to do for our newer listeners and viewers is to replicate the government's consumer price index, which is the government's way of conveying year-over-year inflation or month-over-month inflation. And what Trueflation does is they've tried to take a modern view of this and take real-time data points to convey the year-over-year inflation data every day, okay? Am I saying it's 100% accurate? No. Is the government CPI index accurate? No.
Yeah, and the difference there is, the government data is lagging, right? Most of the economic reports that come out from the BLS or the government in general, it is lagging data. So you're not getting like real time, especially when you're talking about like rent and housing prices, right?
Yes.
Yeah.
Yep. And the rent and housing aspect of CPI, that could lag 6 to 9 months, right, from the real-time data. So why am I bringing this up? Let's start with where the real-time data is indicating right now. The timestamp on this mark is February 8th. It was showing year-over-year inflation, replicating the government's consumer price index basket, was showing year-over-year inflation at 0.68%. Okay? Now, as I mentioned here in a second, the next release date on the government CPI is going to be Friday, tomorrow, February 13th at 8:30 a.m.
Ooh, Friday the 13th.
Friday the 13th, baby. Should we be concerned about something?
I don't know.
Is it a full moon?
I always, for whatever reason, I look at the calendar, the 13th of the month. I always look for it to see when it's going to be on a Friday, and I feel like we haven't had one of those in a long time. But it's not during October, so maybe
we're
okay.
good.
Yeah, maybe
it's only
we're okay.
13th on a Friday in October. I'm here for it. So the previous data released indicated from the government mark that year-over-year CPI came in at plus 2.7%. Okay, so follow me here. Expectations for January data being released Friday is going to show a drop, Wall Street's expecting, of plus 2.5% year over year. Why is this noteworthy, in my opinion? The Fed funds rate currently sits at 3.5 to 3.75%. A reminder for our viewers, that's the interest rate that the government will allow banks to borrow money from them on an overnight rate. The government delayed inflation data again shows 2.7% pending Friday's release. Some real-time inflation data I just mentioned by Trueflation indicates sub 1% inflation year over year. So what do you think happens, Mark, to stock prices in general once the market starts to get the message that CPI inflation data, assuming that research firms like Trueflation are correct, and we see the CPI data come down over the next 3 to 6 months, do you think that gives the Federal Reserve cover to lower interest rates? Right now, Wall Street is only expecting 2 quarter-of-a-point interest rate cuts this year, and I'm quoting via the Chicago Mercantile Exchange interest rate futures. And assuming inflation continues to come down, do you think we're going to get more cuts this year? I'm in the camp that I think we do. And the market also gets a new Fed chair in May, for better or for worse. My final point. What's a topic that is not being talked about enough right now, in my opinion, is the threat of lower interest rates as this year goes on. Lower than the market is currently expecting. And I want to throw this out there. Don't underestimate the tailwind that creates. I'm talking about things about could it see a rise in merger and acquisitions as the cost of borrowing money becomes cheaper? Corporations could refinance their debt at lower interest rates to increase cash flow. Consumer borrowing rates go down. Go down the aisle, I just think Wall Street's a little light on their 2 interest rate cuts for the year. Obviously, this podcast is timestamped. People will go back. I'll be judged later this year. We'll see if I'm right or I'm wrong with my opinion. I feel strongly I'm going to be right, but we'll see. I've been wrong before.
Yeah, and I don't think we're not sitting here advocating for the new Fed chair to cut rates by 75 bips for the first 2 quarters or the first quarter that he is in that position, right? Because as we've, again, talked about several times throughout this rate cutting cycle, is the slower and steadier and more methodical the Fed is about cutting rates, the better equities do, right?
Sure.
And we see when the Fed does what we call emergency cuts, stocks tend to struggle. So I think it's not a one size fits all. Whenever the Fed cuts rates, stocks do well. So I think if we continue along this pace of a few cuts per year, I think that's healthier for the market and the economy in general.
Well said. So my last piece has to do with capital expenditure budgets and what we call the big hyperscalers here in 2026. Hyperscalers are these mega tech firms that are building all these data centers for AI and in data storage, etc. So this is a post from Mike Zaccardi, friend of the podcast, February 9th. Mark shares a chart from Bank of America Global Research. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. What it does, Mark, is it highlights capital expenditures, in essence, these companies' spending budgets of these major tech hyperscalers for the fiscal year of 2026. My key takeaway, massive AI infrastructure race is underhand. Companies are pouring billions of dollars into these data centers and AI hardware, and the companies appear to be so bullish that they're not funding their capital expenditures all through internal cash flows. They're spending more than that, okay? Not a recommendation for or against any of these names, but I'm just going to cherry pick a couple just to give our traditional podcast listeners a feel for what we're looking at. So for example, Amazon said that they're going to be spending around $200 billion in capital expenditures. And they're forecasted to have cash from operations less dividend and stock buybacks of $182 billion. So the difference has to come from somewhere. So now we need to recognize that these companies will send these budgets on the other. They'll spend their budgets, on some other things, not just data centers and AI. But I would argue that's one of the larger portions of these budgets. So why am I highlighting this? At the beginning of the year, I said we will most likely see several periods where the market is debating where we stand within the data center capacity boom. This data makes it very clear that CapEx is surging for GPUs, data centers, infrastructure to support a model that most people would recognize like a Chat GPT and cloud services and others like it. And what is the market concerned about? When we reach a point where the capacity is built out, the growth rates will start to slow. That could affect some technology stock-related profit growth. I would expect this topic to continue to be debated several more times this year. I expect NVIDIA's earnings, not a recommendation for or against the name, but NVIDIA's earnings in a few weeks at the end of the month here in February to have the potential to be the next clearing event, for better or for worse, for the market on this topic. So again, not a recommendation for or against NVIDIA, but rather a reminder from my 2026 outlook on the themes and topics that the market will be focused on. We're already being front and center the past couple of weeks. Your comments?
Yeah, I think, there's been a lot of talk in the markets over really year to date or into the last part of 2025 that, people are asking the question, are we in an AI bubble? And I think the strength of that argument could be made if, we saw crazy stock prices from tech and AI names and not the fundamentals or the capital behind it. You have all of these, really the most powerful tech companies in the world spending hundreds of billions of dollars on
an individual basis.
Right. So it's hard for me to believe that all of these companies who, in my opinion, have some of the smartest minds in the world are throwing, collectively over $1 trillion down the drain or just lighting it on fire.
Yeah, it's good. It's a good point.
So, even though we have had drastic increases in tech and AI specific related stock prices, it's not as if there isn't money being put behind it to develop it and take it to the next level, because that's definitely what's happening.
Yeah, and I think the other take that the market tends to forget is the market likes these mega cap tech names that are growing earnings by double digits year over year. And in a lot of instances, some of these multi-trillion-dollar market cap companies are growing earnings by over 20% per year. Well, how are they doing that? They are literally taking a cinder block on CapEx, putting it on the accelerator, and sitting back on a Tesla autopilot and letting it do its thing right now. And like you were kind of indicating, I don't think these boardrooms will be authorizing this type of behavior where they are literally spending more than they're making if they didn't feel the prospects were fruitful in doing so. And my hot take is they've been rewarded for this activity because earnings have been, progressing at double-digit compounding rates. They're probably going to continue that until it doesn't.
Yeah, and they're, when people are sitting around the boardroom making these types of decisions, they don't care about what happens this year. They don't care what happens next year. They don't care what happens in the next 5 years. They're looking 10, 15, 20, 30, 40 years down the road and saying, hey, we're throwing this money into this because this is where we see things going. This is how we're going to be successful. This is how we're going to continue to evolve our business and survive the competition, right? They're not making these decisions to have retail investors
like the stock for the next quarter or two.
Year. Yeah, exactly.
I just think it's interesting how Wall Street right now, it's classic Wall Street, is talking out of both sides of their mouth, right? They're selling off tech stocks recently because of these large capital expenditure budgets, and they don't like how it's going to affect profit margins. But I'm sorry, they're concerned that the AI spending boom's at a peak. Tell me which side you're on. You can't cherry pick the data on one side or the other and then make that your thesis because it negates the other side.
Right.
So it's interesting. My last comment is, and you're going to love this, we're obviously seeing some sector rotation in the market, right? The headline indices, stock indices you were mentioning at the beginning of the podcast, Dow, S&P, NASDAQ, they're not doing too bad to start the year. I know that the NASDAQ is slightly red, but you are seeing sector rotation. And what's a classic Mark McEvely quote of the Independent Advisors podcast about rotation?
Yeah, and it's I get this from other people, so I didn't invent this, but thank you for the credit. That sector rotation's the lifeblood of markets, right? You can't have a continuing bull market where you just have 1, 2, or 3 sectors leading the way and all the other ones are weak because that's kind of how you get into bubble territory.
Just saying. I mean, it's just interesting how, the largest sector of the market starts to get weak and everyone talks about the viability of the bull market, but no one's talking about the other sectors.
Well, yeah, the complaint for a long time, and I think we brought it up in several instances over the years on the show, is that everyone's concerned about how much weight of the S&P 500 is concentrated in these mega cap tech stocks, the top 5 to 8 names, right? Your Microsoft, Nvidia's, Apple, Amazon, Google's, Tesla's, those type of names. And then you have a start to the year like we've had in 2026 where those names haven't been strong. They've been actually pretty weak on a relative basis, but you're seeing the other names in the index kind of pick up the slack. And you're actually seeing more net new highs than net new lows. And again, that is not how bull markets end.
That's not bearish stats.
You start to see an expansion of new lows, and we're just not seeing that. So again, the volatility over the past 2 weeks, it's very short term, although it could continue. It could get worse. It hasn't at this point. And I would like to think that it's not going to unless we start to see more of the names that make up these large indices start to drop or experience more weakness.
I love doing this podcast with you.
It was a good one this week. Hopefully everyone picks out something that they can use or that they can learn about over the next couple of weeks. So we will leave it there for the week and just want to thank everybody for listening to episode 338 of the Independent Advisors podcast. Catch us next week for episode 339.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.